I absolutely sound like a broken record. Based on history, based on data going back to 1929, we are 78% overvalued in the stock market, the S&P 500, relative to history. Now, you might sit there and say, well, Paul, you got to remember, I've heard it all. And my only response is, you could be right. But in order to be right, and that this market's okay, it has to be different this time. And if you're new to investing, you're going to learn that the 4 most dangerous words in investing are...
It's different this time.
It's different this time. Now, Warren Buffett made the stock market to GDP ratio a very famous ratio. Do you remember what he said, Mo? 'Cause I remember exactly what he said, but I probably obsess over it way more than you do.
Say it.
He said at any given moment, the stock market GDP ratio is probably the most accurate measure of where we stand with valuations at any given time. Okay? He said this back in 2008 when he wrote an op-ed in the Wall Street Journal saying, guys, you're going to do well buying stocks right now. Even though it's scary, the stock market GDP ratio is very, very low. And sure enough, he was correct. And in 2000, when everybody told him he was a dinosaur, he was a has-been, and he was warning about things, he turned out to be correct. So what I did was, the S&P 500 is a market cap-based market cap-based index. It takes the top 500 companies based on the S&P's decisions and puts them all together. And the biggest ones have a bigger weighting than the lowest ones. This compares the Dow. The Dow has 30 companies, not 500. And they base their index based on the stock price of the company, which is absolutely stupid.
So stupid.
It's so dumb, Mo.
Who even thought about that?
I don't know. But basically, it doesn't care about the value of the company, just the price of the stock. Now, to explain to you how that's not useful, let me show you guys how that can be manipulated. So let's take 2 companies. They're both worth $100. Not the price of the company, but all the shares. This company has 10 shares. This company has 100 shares. $10 per share, $1 per share stock price. In the S&P, all they care about is what's the value of the company? $100. Okay, fine. They're equal companies. In the Dow, this one's worth 10 times more than this one because the stock price is 10 times higher. So the exact same value business, but they value this one much higher. Why? Because the stock price itself. All that considers is how many shares the company want to have outstanding. So I only look at the S&P 500. So I went back, I took the S&P 500, the market cap, and then I also took the GDP. And I put it in my own Excel sheet. And guys, if you're part of our community, every morning I announce this stock market GDP ratio and how overpriced or underpriced it is in our community chat. I do it every single day. Every single day after the market's been open. So I went and did this going back to 1929, guys. Look at all this data right here. And we're going to have this soon on our website to automatically update. But I love doing this. We are currently 78%. At the end of last year, we were at 57%. But we've seen a huge surge in stock prices. Have we not? Big surge.
Big time.
In history, this does not include dividends. The average 10-year returns is 6.6%. Makes sense. You put in 3 or 4% dividend in history, you're about 9.5%. But here's the interesting part. When you're overvalued by 30, 40, or 50%, here are the next 10-year returns. They're all negative. When you're undervalued by 30%, not including dividends, the average is 11% return. Makes sense, doesn't it, guys? The more you pay, the less return you make. The less you pay, the more return you make. Look how long we've been overvalued, Mo. We got to 103%.
I know.
It's actually only 103. It was 107 at one point, but GDP keeps going up by a lot. So it really drives down that value. And look how fair value. I also assign where fair value should be. 2471. It was as low as 2000 back in 2019.
It's at 4409 right now.
It's at 4409 currently.
Yeah, 4410.
So guys, what does this mean? Well, let's look at this chart right here. This graphs all of the historical. That's pretty interesting. That's the curve. Is there a correlation, an inverse correlation between how much you pay versus your return? The more you pay, less return. That's an inverse correlation, and that's showing right here. Guys, we've become a broken record because a lot of people in this market have said they're young to it. Look at Mike. Look at you, Mo. You've never seen a real bear market.
Well, the only bear market that I've really seen was like 6 days of COVID.
Yeah, plus last year, kind of.
That wasn't Yeah, I guess technically it was.
But look at 2000, where the internet was created. We had negative years there for a while. We had 3 years in a row of negative S&P numbers.
And then 2008, it was pretty
quick.
Quick.
It was very quick. We haven't seen back-to-back losing years in a since 2000. Mm-hmm. So guys, why do I talk about this a lot? Well, it's all about the sentiment in the market. When I see a company, like when I see 7 of the most valuable companies in the world, in the US, grow so much from year to date, that's kind of scary to me. How could a $1 trillion company, how could a $300 billion company triple in a matter of 4 months? Triple.
And based on zero fundamentals, just saying what they're going to do in the future.
There's a lot of potential for AI.
Yeah.
By the way, guys, don't hear me out here.
There is.
AI has a lot of potential, just like the internet had a lot of potential in 1999, 2000, and the internet has crushed it. But how many internet companies went to zero? The vast, vast majority. That's the key, guys. I want you as an investor to learn this. It's possible to overpay for a good thing, and it's possible to underpay for a bad thing. If you can understand that concept, and if you can understand that whenever you buy an investment, you're buying a future stream of cash flow, you're going to do very, very well. But you also have to be able to pull the emotion out of it.
Yep.
To say, I'm okay if a stock goes up 300%, I'm not involved. Mo and I have zero FOMO. We have not once said, oh man, I wish we'd been in NVIDIA.
Yeah.
Not once.
No.
We're very fortunate that way, and you can be that way too. That is why we have this community of investors. That's why we have thousands of people in here talking. It's about reassuring ourselves that, oh my God, this is crazy. We're okay not being involved. But I always go back to the historical numbers. And it's been a long time since we've been undervalued. 2012 was the last time we were undervalued. And look at the returns since then. It took a massive, massive bull market. The next 10 years were 9.2%. But look at this. In 2008, when the crash occurred, it was March of 2009. We were undervalued by 37%, and the next 10 years without dividends did 12%.
Funny how that works.
Funny how that works. But the hard part is when you have people here thinking the world was going to end.
And when you have people where we are right now saying the world is never going to end. This is great.
That the world's never going to end, that nothing will ever get bad.
Yeah, it's good. This is the new normal.
This is the new normal. And I see so many of those hypes. And guys, by the way, there's been a lot of companies wiped out. When all those hypes were talking about Peloton, Palantir, Workhorse, Nikola, and all those stocks are down 60, 70, 80, 90%. That's incredible. And guys, don't get me wrong. You're going to buy stocks and we're going to buy stocks that go down. This is the difference though. If you buy based on fundamentals and you can come up with a value for the company, how do we come up with a value of the company? Using our stock analyzer tool. If you can come up with that, when the stock price goes down, you look at it as an opportunity to buy more shares. That's the big key. That's the absolute big key. This is the thing I always show people. This is SPY, the S&P 500 index fund. Where do you wish you'd bought? If I only gave you 5 opportunities to buy in the last 30 years, you wish you'd bought here, 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 and here. That's 6 opportunities. Let's get rid of that one, whatever. And guess what? Where did the world look the worst? Here, 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 and here. Guys, the best opportunities come when things look the worst. Because unless you believe that everything will be bad forever, the stock market's not going to zero. Are there companies that'll go to zero? Yes. And that's why we're teaching this process of understanding the fundamentals of the business. That's why we do that. If you learn that, then you look at every stock price going down as an opportunity to buy more, to buy on sale. Mo, the big mistake that I made was realizing that stocks could be irrational longer than that could be solvent. Mm-hmm. I started exiting stocks way too early. I've learned that lesson. And now I'm also buying shares of companies that I like to get myself in the habit of always buying companies that I like, no matter what the stock price is. Sorry, no matter where the market is. Yeah. As long as the stock price is selling below the level I think will give me an adequate return on my money, I continue to buy.
Right.
And that's the thing I want you. You probably hear that and go, oh, that sounds awesome. It does, and it is awesome. But it's all about having the right process. Right. Think about what you do for a living. You do it very well. But if I came to your job right now, I'd be scared. I'd be like, what am I doing here? But you'd be like, why are you scared? It's because I don't understand. That's what we're trying to teach. We're trying to teach people to fish so you understand it better. When Mo and I started to understand this better, We became much, much better investors. We're okay saying no to things. We're okay having zero FOMO. We love having zero FOMO. When you have no fear of missing out, you're going to make a lot less mistakes.
Makes life a lot easier too.
Doesn't it though?
Yeah.
It makes life a lot easier. And that's the big key here, guys. It's all about understanding fundamentals. And this stock market to GDP ratio has been in dark pink, which is over 30% overpriced, for I think the longest period in our history, except for the Great Depression. Nope, even longer than that. This is longer than the Great Depression. So guys, you have a decision to make. Now, it doesn't mean don't invest here. We still encourage people to invest dollar cost average in a low cost ETFs. Because at the end of the day, you don't know what the market's going to do, and your job is to do your job well and save. But if you desire to pick individual stocks, there is a process that'll help you. And when stocks are selling at their low levels, being able to be more aggressive and say, I'm going to increase my allocation of stocks because I learned that this is a very good price to pay for historical numbers. So guys, this makes sense to you? I ask one favor. Subscribe to our channel. Actually, two favors. Subscribe to our channel and share this with somebody else who tends to get a little worried about stocks when they go down. Thank you very much for your time.